Welcome to the show, Benard.
Anthony, I am so excited to be here. The launch of a relatively, new podcast. This is super exciting. We've connected in so many other places, and it's great to be part of this.
Oh, yes. I love technology, the use of technology of connecting. But like you said earlier before we started recording, it's about having that personal, somewhat personal or in-person connection and utilizing technology for that as well.
Yeah, it's cool how we got to connect on LinkedIn and through other mutual connections on LinkedIn, and finally it's led to this. But really, online is great, but there's nothing like a personal connection.
That is so true. So a little intro about Benard for the listeners. Benard is a principal advisor of ReSure Financial. Benard empowers individuals to optimize their finances using proactive and innovative strategies. He provides an integrated approach to tax and financial planning for real estate pros, focused on their unique profiles and opportunities. Benard, can you give the listeners a little bit more about how you got to where you are right now?
Glad to do that. The background begins with CPA, financial advisory, and noticing that there's a big area of finance and investment that is neglected. It's not promoted to the masses, and it should be. And that is fundamentally, it's about real estate, but more broadly, it's about a whole world of opportunity that only a small segment of the population is getting to access. While most of us are getting the same products promoted to us again and again and again. So it's about noticing that there's something missing in the market. It's about noticing that people are getting promoted products to benefit salespeople and not getting access to more unique opportunities that they should be taken advantage of.
Awesome. I like how you saw a problem and you figured out a way to kind of solve it and help other people along the process. That's what investors and entrepreneurs in general are supposed to be doing. Not just trying to make money, that's just the benefit, one of the benefits, but it's just solving issues, it's solving problems. And I love how you did that. So what are some of the problems you saw that you were trying to help innovate and fix?
If you'd ask most people, most Americans, where a lot of their wealth is tied up, and where is it locked up, it would be inside of retirement accounts. We're always retirement accounts, IRAs, 401ks have been promoted for many, many decades. And it's amazing how much money has accumulated within these accounts. There's about $30 trillion inside of the tax sheltered system.
Wow. Can you repeat that number once again? Because I didn't think I heard you clearly.
I know. It's an astounding number. So it changes kind of by day to day, but it's been hovering at about 30 trillion. It may be above 30 trillion today.
Wow, $30 trillion. And I think I heard that number before, and they said that number is bigger than the U.S. debt in general. Am I correct?
Yeah. Have you heard that from me? That's generally how somebody else I thought I was the first one that pointed that out. It is greater than the U.S. national debt. These numbers are just so staggering that we really can't even grasp them. You know what I mean? At a certain point, the numbers just get too big, too grand. It's just a scale that we cannot think about. It's like trying to grasp the size of the universe. We can think of terms of miles. We can think in terms of, what the distance between here and China, maybe here on the moon, here on Mars. But then you start thinking about the Milky Way galaxy, it just, light years. So $30 trillion is kind of, in dollar terms, it's in that realm. It's just a staggering number.
That is $30 trillion. I know what I'll be doing with $30 trillion. I'll be vacationing somewhere.
You know what, Anthony, you just brought home the point. With $30 trillion, you don't know what you do. There's nothing that you can do with, what would you do with $30 trillion? Who knows? It's too much to think. You go on vacation full time. You can retire, quit your job, and stop working for the rest of your life with a couple of million in the bank, for sure, right? With with 30 trillion, there's no way you would figure out what to do with 30 trillion bucks.
That is so true. Completely agree. So for those people that don't have the 30 trillion, but they have a portion of it, how can they use it to benefit them?
That's such a great question. Now, to continue, what's going on with this $30 trillion, and how do we get to accumulate that much money inside of these accounts? So these accounts are generally promoted for tax benefits and long-term savings benefits. And the way people will hear about these accounts is from one of two ways. Most often, it's going to come from a financial advisor or from some company representative that's helping people with the 401k plan. Now, these 401k plans, if you just do a Google search, 401k litigation, you will find that for the most part, for tens of years, for decades, these served as a slush fund where at financial firms were just taking advantage of employees' money. The amount of fees that were being charged to employees without them knowing, the poor investment choices, it ended up serving as a conduit, as a way just to get money and collect fees. So most often, although these were created by Congress in the 1970s to provide a way for us to save in a tax advantage way, financial firms realized that, hey, this presents a great opportunity. Let's promote 401k. Let's promote IRA. Let's get this money captive. Let's get this money locked up. And then we're going to manage it and charge lots of fees. That is really the story of 401ks and IRAs. But it doesn't have to be that way. There's nothing in the tax code that says you have to pay fees. And there's nothing in the tax code that says you've got to give the money to a financial advisor, right? It's really totally distinct. Financial advisory firms realize that this is an opportunity. If we can capitalize on this law and get the money onto our platforms, we can do well for ourselves. So let's talk for a moment about what you really can do with this money and what it says in the tax code about it.
Yes, please.
Well, so Anthony, if I were to toss a question back at you, what would you think the tax code says about investing IRA or 401k money?
What do I think about investing with a 401k?
What do you think the tax code, what do you think Congress said about investing? Do you think Congress said anything about investing with mutual funds or in stocks using 401ks or IRAs?
I would say no. I think they'll try to be like in the capital markets, like the stock markets, but they wouldn't put much emphasis outside of real estate or outside of that in general.
Okay, the awesome answer. The Congress was more or less silent. Well, not more or less, totally silent about saying what you can invest in. Congress did say just a bit about what you can't invest in. Congress said you can't invest this in collectibles. That means don't go buy fine art or alcohol, right? Which some people do purchase that for investment. Don't buy that. But other than that, it is silent. So it doesn't say a word about what you can invest in. It doesn't even say you can invest in capital markets. It does not say you can invest in stocks. It does not say you can invest in bonds. All it says is you can't invest in collectibles. So anything other than collectibles is
fair game.
Fair game, right? And real estate is as fair game as the stock market from the perspective of Congress and the IRS. So people have to recognize that there's a tax side of this, and then there's the investment side of this. All Congress said was put money in this account, we'll give you a tax deduction, and if you invest it, you can invest tax-free. What you invest in, we're not telling you what to do. We trust that if we incentivize you to invest for yourself, you can do a better job than anybody else, right? Let's just incentivize you. We'll give you benefits and you invest. We know what happens if the government tries to micromanage things.
Oh, yes. It doesn't go too well.
That's right. So thankfully, the government here did not say, all right, we're going to manage the money for you. They said, we'll let you manage it. And we know if you lose the money, it's on you. And if you make the money and the tax savings and tax benefits, you got the risk and rewards. We can leave it to you. But then what happened? Other third parties came in and said, we can't trust you. You cannot trust you. Don't trust yourself. to manage or invest the money. Give it to us. We will manage it for you, right? And that's where the money management industry comes in, and they charge all these fees. Now, the money management industry is primarily centered around mutual funds, right? And so they create these funds, they charge the fees, they charge marketing fees, they take commissions, they take asset under management fees, and they work most efficiently with mutual funds, because you know how difficult it is to manage mutual funds?
Oh,
It's
yes.
real. Well, if you're a financial advisor, it's very easy, right? You just go click, 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 and there are mutual funds in an account. So mutual funds are very easy for financial firms to trade and buy and sell on your behalf, right? It's just a couple of clicks on a mouse screen. They cannot efficiently manage a value add multifamily deal in Georgia or Tennessee or Michigan or anywhere else in the United States. They cannot manage private deals it's just not efficient for them. And from a regulatory perspective, they can't do that. I don't know if you've ever worked with a financial advisor, but if you have, and even if you haven't, what would you envision happens? Have you ever seen a financial advisor say, you know what, I've got a great syndication for you. You can put money into a real estate syndication. There's a great deal. We got a good buy, value add. We're going to reposition. It's going to be repositioned, and you can do that.
I've never heard financial advisors say that. Not for something like that.
Yes, and why not?
That's
what
a
would you
good
think?
question.
Why not?
I would say, in my eyes, is they can't. Like some laws say they can't, or company policy says they can't do it that way. That's what I believe as.
So that is definitely one part of the answer. But another part of it is that they can't sell you that, right? It's not something that they're able to monetize, right? They cannot, right? If you went to a financial advisor or a financial salesperson, right, what their goal is to sell their product. That's really what it is. And an analogy that I've used, and maybe this has come full circle, maybe you've heard it elsewhere, because a couple of people have told me they're gonna be using this analogy going forward. If you go into a restaurant that sells Mexican style food, Mexican cuisine, right? Are they going to tell you that, down the block, there's something called French cuisine or American or Asian, and, down the block there is a French bistro and you can get French cuisine there? Are the folks, is the server at the Mexican establishment going to tell you that?
Not really.
Of course not, right? They're going to present you with their menu because that's what they sell, right? If you want to know the full array of opportunity, you've got to walk around the block, perhaps do a Google search and say, hey, let's find out what kind of food is available in this neighborhood. What kind of variety is available? When you walk into any particular restaurant, all you get is their menu. And that's okay. However, what people fail to realize is that when you work with a financial advisor, all you're getting is their menu. They're there, they've got stuff to sell, and they've got their product, they've got their inventory. That's what you're going to get presented with. Now, it could be stuff that's good. It could be stuff that's good for some, not for others. But you can be, fairly confident that they're not going to tell you about products, about a style that they can't provide.
So true.
So that was really what has happened. It's other people have realized that these accounts can be used as a source of money. You may hear about it from a CPA. CPA will tell a person come tax time, hey, these are great accounts, get a tax deduction. Well, you get the tax deduction for putting the money in. Now, once the money is in the account, it grows tax-free, but the CPAs are more focused on the tax return. Once the money is in that account, it will grow tax-free, but that doesn't impact your tax return, and it ends up falling outside the purview of your CPA or tax preparer. They're focused on getting the tax deduction. They're not focused on what happens once the money is inside the account. So what we're here to do is give people the total flexibility that the tax code intended, which is to give them the money in a bank account so that they can invest it in any asset that they choose. Now, we're not telling you mutual funds are bad. We just recognize that you have a right to choose. And you may have opportunities that are better than what's available from the financial advisor. They may be, or you want to diversify. But it's all about recognizing that you are entitled to the full scope, the full spectrum of opportunity that's available to Americans and that you should know about. So that's what we do. We set up retirement accounts that give you the money in a bank account so that you can choose your asset class and your deals.
Awesome. I know from quite a few people that they're given something and that they're told something and that's what they stick with. Okay, you can't do it this way. I can't do it this way. They don't ask questions or they don't think they should have options. But as entrepreneurs and people like yourself and myself, we kind of vie for options or to provide options for people. What options can ReSure, can you help people provide as far as what you do?
Yeah, that's awesome. And I love how you say that. It's really all about options, access, and questions. And I like to say questions are more valuable than answers because having questions can enable you to find new, learn truths, things that you didn't yet know. And if you don't question, people that think they've got all the answers, or if you think you're working with somebody that has all the answers, you may not ask enough questions. So you should always question. And in terms of the type of assets that we help people with, it's really broad. Real estate or some real estate angle is generally what most of our clients are doing. Real estate is one of those things that is accessible to everybody in one form or another. There are so many different real estate angles, be it on the equity side, the debt side. Are you going to do a direct deal? Just buy a property. Are you going to do, get involved in a syndication as an LP, crowdfunding? There are just so many different ways of getting into real estate. And if you expand that into notes, performing notes, non-performing notes, private money loans, hard money loans, there are just so many angles and so many ways to get in, and the barriers to getting in are just getting lower and lower and lower. And there are syndicators out there like yourself that are making opportunities available to everybody. Yes, you cannot go online to a brokerage firm and get into a syndication. And that's really why there's opportunity there. Being that it's not as easy to get in, that's why there's more opportunity on there. The stock market, there's really nothing. Have you ever heard of efficient market theory?
I have not.
Okay, that's a scholarly theory. The fellow that introduced that actually won the Nobel Prize a couple of years ago. And he has posited, and it's more or less been fairly proven, that don't try to beat the stock market. You cannot beat the stock market. It's a losing proposition because, with a market like that, with hundreds of millions of people around the world monitoring the public market, the price that's presented is, so to speak, the fear price. If a stock is trading at $50, you can assume that all the pros and cons of that stock are already priced in. That is the actual value. Yes, there's some person out there that thinks the stock is, one analyst that thinks the stock is worth 40. There's another that thinks it's worth 60. And there are millions of others that have other, opinions on the price. And they're buying and selling and shorting based on their thoughts. And the market has settled on $50. So now that $50 price for the stock represents the input of millions of people. So if you think you're smarter than that, you're making a mistake. Now, it's essentially gambling. So if you think that stock is really worth 60 and you buy it for 50, it may turn out the market will move for you or against you. But the $50 price is really the price that aggregates the inputs of millions of people. And so you'd see that, one stock analyst says 60, the other one says 40. and there are so many other opinions. You're just one more opinion over there that doesn't really move the needle. So the $50, that is the price. So there's really no opportunity to outsmart the market. But with private investments, you can, if you're clued into your real estate market, you can find a deal that is really a good deal. It's a unique deal because you're able to influence the outcome. You can look at this property and this asset and say, hey, we can do this. And you know what? The rest of the world is not looking at that and may not be privy to your perspective. It's a deal. It's a local deal wherever that is. Real estate markets are hyper local, and you can have an insight that's not available to the rest of the world.
So true. That's one of the things I like about real estate, is not just because it's a very tangible asset, like you could drive by, you could see it, you could kind of touch it if you really wanted to, but you could have a personal influence on how the property performs, not just by, okay, I raise the rents, but there's ways to operate the building that makes the building more favorable to the people that are investing into that opportunity, because that's what real estate is about, is providing opportunities for other people.
Yeah, so well said. Because, the stock market is more or less a spectator sport. For the most part, you can buy, you can watch. There's nothing you can do. You can buy Apple stock, but you can't tell Apple what to do. You can buy WeWork, but you can't influence the outcome. You can buy Tesla, but you could just watch it go up or down and gyrate. So really, the opinion, this is another example. For the most part, this is beginning in the 1960s. Certain scholars and people in the mutual fund industry said, hey, guys, we're not doing the American people a service. They're giving us money to manage, and we're charging them outrageous fees, but we're giving them poor results. Stop trying to beat the market. When you tell people that you can pick stocks on their behalf, and this way they should trust you with the money, you're not helping them, because they're actually falling behind. They're losing because of all of your attempts to pick stocks or get in and out of stocks at a certain time. Now, for about 40 to 50 years, Wall Street fought this. Today, they've given in but for about 40 to 50 years, they fought this, and they kept taking people's money, charging exorbitant fees. And again, they would make commissions primarily in those days. So every time they bought or sold a stock, they were taking 5 to 10% of your money. Now, Jack Bogle is somebody that passed away this past year. He was a crusader that for a big portion of his life, was fighting an upstream battle to convince the American public that the Wall Street, for the most part, is mismanaging your money. In the late 2000s, it's over the last 15 years, for the most part, people have come around that Wall Street has recognized, for the most part, they've lost that battle. They no longer try to tell people, we can pick stocks for you. But it does illustrate that there's a fundamental flaw with just blindly trusting other people with your money. Because for 100 years, Wall Street was taking people's money just to perform poorly for them. In fact, there's an awesome book. I don't know if you've got this as part of your podcast, but sometimes I get on a show and they want to know, do you have a book for us to read? A book you recommend? Well, there's a book written maybe in the 1930s. I got to check. It's an old book, but it's a really small book, quick read, amusing. Where Are the Customers' Yachts? Right. So this is a book that's written, I think, close to 100. We're looking at in the 30s or 40s, recently republished. And what it's about is, somebody noticing about 100 years ago, more than 100 years ago, looking down at Wall Street and seeing yachts. And he's saying, whose yachts are those? And they're like, oh, those are the Wall Street stockbrokers' yachts. And the fellow asks, okay, but where are the customers' yachts? Right? If the money managers have yachts because they're doing so well for their clients, then the clients should probably have yachts as well, because, it's their money after all that's doing so well.
Yep, I totally agree. It's like benefiting from somebody else's money and they get nothing in return, which is, to me, is no good.
So, so that's what we're all about. We're all about giving people the money to pick their investments. We have no involvement in the actual investment selection. We just give you the control so that you can choose.
Awesome. It's like you said earlier, is providing opportunities to be able to ask questions like and figure out why you should do something, what is the best choice for you, and what opportunity presented will be the best choice for you.
Yeah,
So with
that's
that,
exactly it.
that leads to my next question is how can someone use a checkbook, 401k, or a self-directed RRK to find opportunities in real estate?
Yeah, that's awesome question. And that's where we're really able to help people because so many people have their investable money, that $30 trillion inside of retirement accounts. Well, just because the money is in an IRA or 401k that offers you certain investment options does not mean that you cannot move that money into an IRA or 401k that doesn't restrict you at all. So we set up accounts that get the money in a bank account, but retain their status as IRAs or 401ks. So you can roll the money over to the type of accounts that we set up. And once in there, you can put the money into the deal of your choosing. Of course, you can still put the money into mutual funds. We're not about restricting you. It's about broadening your options. It's about giving you greater options. It's about putting that money directly under your control so that you can choose. And of course, mutual funds, we're not saying don't use them. We're just saying there's a big world out there, and you should have access to all the options. And I guess to answer your question more specifically, we make it as easy as writing a check using a bank account. So it's ACH, it's wire, right? When you need a deal to fund, you don't have to ask anybody's permission. You sign the deal docs. And let's talk about syndications, right? That's your world.
Yep.
And syndicators are the ones that really make these opportunities accessible to the public, because otherwise you cannot get in on these investments. People have got their jobs. They've got whatever they're doing. Real estate is, I find real estate to be this, it's a bit of a hybrid. You cannot do real estate by sitting in your office. You got to get out. You got to get your hands dirty, so to speak. You got to be out there. You got to really find that opportunity. So in a certain extent way, it's like running a business. But, people can get in on that just as they get in on other investments, but they got to recognize that, hey, it's not going to be on the computer. Most likely the best opportunities are going to be available through syndicators that are finding the deals, running the deals, managing the deals, and that are raising funds from private investors. And, say you're out there, you've got your deal, now you've got to fund it, you've got it tied up, you've got your soft commitments. Well, where's the money going to come from? So our investors get the money in a bank account. You give them the deal docs. So if they're using a 401k, they're just going to sign that as the trustee of their 401k. They sign the deal docs. And however you take money from investors, ACH, wire, check, that's what you'll get. It's going to be very much like working with any other individual investor, because your investor that's using a 401k or IRA will have direct access to the money.
Love it. Making it easier for other people to find opportunities and kind of jump on the opportunities that are presented by sponsors like myself and others out there. Why should someone use a 401k or a self-directed IRA for tax purposes?
So there are two components of that. There's putting the money in there, provides tax benefits, and then there's investing the money while it's in there, provides tax benefits. So IRAs now come in many forms, as do QRPs, also known as qualified retirement plans. But for the most part, we focus on Roth IRAs, traditional IRAs, and 401ks. Now, we do simple IRAs, we do SEP IRAs, we can do defined benefit plans and cash balance plans. But for real estate investing, the three primarily that we're going to focus on are going to be traditional IRA, Roth IRA, and checkbook 401k. And the checkbook 401k actually includes a traditional and a Roth component. But do you think we should back up a bit and talk about what traditional and Roth are?
Yes.
So traditional IRAs and traditional 401ks, the type of accounts where you get a tax deduction for putting money in. So say you put $5,000 in, you get a tax deduction that year of $5,000. Now, on the traditional 401k, you can put in up to $56,000. So you can get really, really powerful tax deductions using a checkbook 401k. But with those traditional 401k, traditional IRA, you get a tax deduction up front. Once the money is in the account, you get to invest it on a tax deferred basis, which means for as long as the money is inside of the traditional IRA, traditional 401k, you do not pay any taxes on your investment returns. So it's tax-free investment for many, many years. But somewhere down the line, say age 70, you have to start pulling money out of these accounts. And at that point, as money comes out, it is taxed. But you get the incredible benefit of investing it for decades without paying taxes. So that is really, really powerful, because the biggest drag on your investment compounding is
taxes.
You got it. Taxes. So between your state and federal income tax that you're going to pay each year on your investment, it's just going to have a devastating impact on your compounding of your returns. So the longer you can keep that invested inside of a traditional IRA, traditional 401k, the greater it's going to grow. But when it comes out, you pay taxes. Now you can manage that tax liability later, right? You can pull it out in a year where you have less income. So you can maybe today, during your earning years, you may be in a high tax bracket. When you're 70 years old, you may be retired and maybe in a lower tax bracket. So there's incredible tax deferral and potential for tax elimination because it's going to come out at a lower tax rate. So that's really, really powerful.
Oh,
but
yes.
that's contrasted with Roth IRA and Roth 401k. In a Roth money, there's no tax deduction for putting the money in. But once the money is in there, it will never be taxed again, ever. Tax-free forever.
Wow.
Now, yeah, go ahead. What are you saying, Anthony?
That's phenomenal to have that option, like to be either tax deferred to when it goes in, but it's taxes out when you take it out, or to be no tax deduction coming in, but not taxed at all. And that's the biggest, I want to say, kind of liabilities for people in general is taxes, and not to have to pay some of it. Phenomenal.
Yeah, that's super powerful. And I'm going to ask you a question that I get all the time. I get this question all the time. And let's hear what you say about it. So would you prefer traditional or Roth?
Ooh, good question. I'll go with Roth because you don't have to pay taxes at all. That's just my opinion.
And let's refine the question. I like that answer. Let's refine it. Perhaps, when would you, is there a particular kind of investment that you say is better suited to Roth than others?
Ooh, that is a good question. I would say it depends on a person's strategy and their financial background, but I'll say it will vary.
Okay, yeah. Most things vary. Here's where the Roth becomes the clear winner. And the best way to illustrate it is to use some extreme examples. Peter Thiel, Max Levchin, Mitt Romney are reported to have IRAs that are worth hundreds of millions of dollars. And if I had to ask you, how do you reach that point, right? An IRA, you can put in $6,000 per year today. When these guys made the money, it was a lot less. It goes up gradually over time. So how do you end up with hundreds of millions of dollars inside of a Roth IRA? Now, yes, you can do a rollover maybe from a 401k where you can get much higher contribution limits, but how do you get to hundreds of millions of dollars?
That's a good question. My answer to that would be to have the money work to make more money inside of IRA, if somehow.
Okay, yes. Now, one thing I can tell you that was not an investment that they made through a financial advisor It's a kind of investment that a financial advisor would have said, don't do it. It's too risky. Don't do it, right? Because again, a financial advisor, not to their, not like there's something against them. You have to appreciate that for the most part, they want to avoid any kind of liability, right? They want to tell you, get into diversified stuff. This way, nothing can really go wrong. And if anything goes wrong, you can't blame them because, hey, it's well diversified. But that means to say they're not going to tell you, they will always discourage you from taking some kind of deal that can give you a huge payoff. So what those folks did, Peter Thiel, Max Levchin, they invested in startup companies that you could not get from a financial advisor, that you could not get in a regular IRA, right? They invested in PayPal, in Yelp, right? They invested in those companies when they were startups, when you can get in for a couple of $1,000s and buy a nice chunk of the company. And today, those shares that they bought for a few grand are worth
hundreds of thousands of millions of dollars.
Hundreds of millions.
Wow.
Yet not everybody's got an equal slice of that 30 trillion. Some people have slightly bigger slices than others. But the only way you get to have the potential to have that kind of slice is by taking private investments. Now, that kind of investment, would you want to have that in a Roth IRA or a traditional IRA?
Ooh, I would say the Roth IRA.
You got it. You hit the nail on the head, right? Think of this. They bought these shares for a couple of $1,000s. Let's say at most for tens of thousands of dollars. How much could it have been at that point? So say they bought it for $50,000, right? Today it's worth, let's just use round numbers. Let's use 100 million, right? It's less than the hype that's out there. Supposedly worth a lot more than that. Now, in a traditional IRA, they would be someday have to pay taxes on all that money. With a Roth IRA, no taxes ever. Right? So they didn't get a tax deduction for the $50,000 that they initially put in, right? But the $999,950,000 is tax free. Had that $50,000 been in traditional IRA or traditional 401k, they'd be paying taxes on that 100 million.
Oh yes, and I'm pretty sure they'd be very upset about losing money on that much money that they could have gained.
Yes, so you got to think about what we think is you always have to have access, and the great thing about the checkbook 401k that we establish is that it has both components in it, and you can easily move from one to the other. So you can actually you can do traditional, you can do Roth, and it's all inside of one plan.
Wow, that's phenomenal. That is awesome to hear. I'm sure the listeners will love it as well, to have the option to have direct access to their own money and not have somebody else make fees off top of it, or phenomenal fees on top of it, but to be tax deferred or tax free for however long they keep it into that account.
Yeah, phenomenal. And on the Roth side, it's tax free when you take it out as well.
Awesome. Thank you for being on the show, Benard. I greatly appreciate it. We're going to shift into my little fire rounds for the show. I have 3 questions.
Tell me about this.
I like to keep the guests on surprise. I keep you on your toes.
Okay, let's do this. I'm getting nervous.
So my 3 questions for you. My first one is, what is your favorite late night snack?
Favorite late night snack? Yeah. Favorite late night snack. It's getting kind of. Usually, I'll tell you what. It's usually going to have peanut butter in it. Now what exactly it's going to be is going to vary, but it's going to have peanut butter in it.
So either like a peanut butter sandwich, or is it like a peanut butter filled pretzels?
It can be. It's whatever I find first.
Oh, that's awesome. For me, it's candy. I can't get enough of candy. I try to hide it from myself because I like it so much. So my second question for it. Is, what book had the most impact on you?
Which book had the most impact on me?
If you could shorten it to one, Because I've heard 3. Some will have 1.
Okay. Let's go with what's his name? Let's just say his name again. I'm going to Google this right now, but he is a great author. He's actually focused on Bernstein. What's his first name? He's a neurosurgeon. How can I forget the names of his books? He is a neurosurgeon that became a financial advisor. And then he went out and he wrote lots of books about investing. I think his name was Bernstein. And I read a couple of his books. Let's see, Financial Manifesto. Let's see, 4 Pillars of Financial Investing is one of them. Let's see. And his focus is very much really on the mutual fund industry, showing how traditional financial advisors, William Bernstein. Okay, William Bernstein. And his focus is really on focusing on how the traditional financial advisory cannot be relied upon. You cannot trust them because they're really out there to sell you stuff. And for the most part, they're just salespeople as part of a distribution channel. So his name is William Bernstein. And let's say one book, I think it's actually it's a bit of an abridged version of some of the other stuff that he's read. Can we go 2 books?
Go ahead.
All right. The Investor's Manifesto and The 4 Pillars of Investing.
Interesting. I'll definitely have to check those books out. All right. So my last question for you, Benard, is what do you like to do to help you relax from the busy day? Like, what do you do to go?
Reading. That's really what it is. It's reading. Always got a range of books that I'm in the middle of reading. So they're not all investment related or tax related. It's about an array of topics. And, frankly, I think what I'd find really most relaxing is something that's not related, to what I'm doing. Taking something that is hopefully somewhat intelligent, but has nothing to do with finances or taxes or investing.
Yeah, I totally agree. Sometimes just reading a good book for me is like doing some type of brain activity game, like Sudoku. I like doing that in the morning, gets my brain motivating.
Yeah, when it comes to like crossword puzzles, I can get completely carried away.
I could never do those. Well, I say couldn't, but just not my cup of tea.
Yeah, everybody's got their thing. I've always loved crossword puzzles. It's and they're really different brain types almost. Like the Sudoku people. Like Sudoku is, I'm not into Sudoku. And I kind of say there's Sudoku and then there's crossword puzzles, and everybody's got their. Not too many people love both of them.
Yep, that is so true. To each their own, I guess, right?
Listen, that's what makes the world a great place.
Exactly. You gotta have diversity and options. That's the beautiful thing about people in general. Is there's so many different things out there to try to do. It's phenomenal.
Yes.
But thank you, Benard, for being on the show. I greatly appreciate it, for taking the time out of your day to be on the show, especially a brand new podcast like this. I greatly appreciate it.
Anthony, great to be on the show, and I'm looking forward to listening to this episode and all the future episodes.
Awesome. What is the best way the listeners can get in touch with you?
Best way is check out our website, 401kcheckbook.com. But they can also Google my name or Google ReSure Financial, ReSure LLC, and they'll find lots of stuff out there. We've got lots of content, great content, lots of podcasts, webinars, So if you want information about this topic, do a Google search for us and you'll find lots of stuff.
Awesome. Well, once again, thank you, Benard, for being on the show. I greatly appreciate it.